Cool, guys. I think let's kick off. We've got quite a lot to talk to you about this morning. But first, welcome to our last session for 2023. Can you believe it? It's 31 days left until the middle of December, which is typically when our lovely industry starts shutting down. Whatever dreams and goals you've had for 2023, you've got a few weeks left to make it happen. Before we start, we've got some good news and some bad news. On the bad news side, this will probably be the last time you see young Lisa Paulson online with us. Lisa's moving on to some bigger and better things at the end of the year. So we'll really miss her. Lisa, thanks for everything you've done for us. On the good news side, our Seed Global Fund has yet again been nominated as a finalist in the Citywire Awards. The awards have been running for 3 years. We were finalists in the first year. We won the award last year, and we are finalists again this year. So we're quite excited about us. And on that note, we're talking global today. So Ian is going to give us some real insights into the lay of the land from a global perspective. And then Tawanda and Mike is going to take us at quite detail and give us some insight into the two seed global funds. With the rand trading at sort of 18.24 this morning to the dollar, perhaps a great opportunity for all those clients who've been waiting for a good strike level to externalize some investments offshore. And just before we kick off, some good news on the economic front, especially from the US yesterday on inflation and interest rate expectation, causing a bit of a risk on environment and risk assets to have a little run. So Ian is going to give us that update just now. And also on the local fund, our jobless rate has been declining for the last 8 quarters in a row. And we've added 2.4 million jobs over that period, which is fantastic. Foreigners are finally demanding our government bonds again. And like I said, our rand is trading at very reasonable levels. So maybe a very opportune time to have a discussion around the global landscape. On that note, Ian, I'm going to hand over to you. If you guys have got any questions, you're welcome to just put your hand up and ask them or put them in the comment section as always. Thanks, Ian.
Awesome. Great, Adi. Thank you, man. And yeah, awesome, guys. Great to be with you again. It's been quite a year. I can't believe we're near the end. So yeah, I've got to just start off with a couple of quotes. First, this one from this financial advisor. Can you believe it? Risk is what's left over when you have thought of everything. In other words, risk is what you don't see. And that can be positive and negative. In some respects, we've had a bit of positive news yesterday. Many people didn't see it, or the market didn't necessarily. Someone's got their. Okay. Yeah, and then that sort of follows on to the next quote, which is from Nassim Taleb. If that's the case, rather invest in preparedness, not in prediction. So that's what we need to do as advisors, obviously, and investment analysts. We've got one more quote, which is also apt, and this comes from Jeff Bezos. And some of these I found obviously from the latest book, which is same as ever, from Morgan Housel. But Amazon founder Jeff Bezos said this. He frequently gets asked the question, "What's going to change in the next 10 years?" Everyone's looking for what's going to happen, what's going to change. And it's a very interesting question. He says a very common one, but he almost never gets asked the question, "What's not going to change in the next 10 years?" And I submit to you that the second question is actually the more important of the two. So yeah, certain things don't change. And so what I thought, let's just put up the same slide as I had last time. Just change the heading. These are sort of market risks over the years, as noted by Bank of America. And yeah, these things ultimately don't change. There's always something to be worried about. The last few years, we've had the COVID pandemic, obviously, which was a big one, the inflation issue, then the interest rate hikes. And if we extend that into the current year, we've had the pretty much the extension of all those same issues. The concern for most of the year, and we saw obviously a big change yesterday, was the inflation concern. It led to more interest rate hikes globally and around the world. We had the failure of US banks. We had a lot of concern about the US dollar as the reserve currency, a lot of concern about the US debt levels, and that's ongoing to the point where we've also now, just last week, had Moody's adjust their credit rating, their outlook from stable to negative. We had a lot of focus on the BRICS, and again, the vulnerability of the US currency, and clearly a lot more geopolitical tension. So these things just keep on hitting us. And these are the things that just won't change. I mean, the headline news will change, but it just seems to be worry after worry. And so what you have, if we look at the various indices, these are all obviously measured in US dollars. I've changed the SA All Share. Previously we had that in rands, but I've just to make it more uniform, we've converted that to dollars as well. So we've had big moves up, big moves down, and obviously the last 3 months across the board for most risk assets, except for certain things like gold had bounced up, and I've put Bitcoin on there as a big sort of risk on or risk off asset that traded counter-cyclically. But the last 3 months, big negatives. Obviously, we halfway through November, and we've had a huge uptick already. So, all things being equal, if we put this chart up next month for the end of November, we're going to have a big uptick again, a big green one. So that's the month by month volatility that we go through as investors, and obviously for our clients. And I thought, okay, well, let's just extend that out to the annual numbers, and this is just going back a few years, and obviously year to date. Again, these are all to the end of October. And so despite these concerns, you've had certain markets, obviously not all, have big green numbers. And again, this month has been a huge up month in the Nasdaq, the S&P, and obviously the global market. So these numbers are quite a little bit out of date now. What hasn't performed well is obviously the emerging markets. So China, and by then extension to emerging markets, it's been negative. And obviously the JSE measured in dollar terms. So that's obviously looking at from a global perspective, where assets are measured in dollars, has been negative. Obviously, again, you've got gold trading a bit of counter-cyclically, so we had a nice bounce up there. And obviously then, just for a bit of reference sake, the real risk asset bouncing up massively, but that's exceptionally volatile. So I think it just goes to show that, despite this negativity, we've actually had a good year. But if we look at the next slide, and this is something we have chatted about, it's been very narrow, the market. So a lot of the gains most of the gains have been US, and inside the US, the bulk of the gains have been the technology shares. What this chart shows is just the Nasdaq relative to the broader market, year in, year out. So when the red line is above the zero, Nasdaq is outperforming, and you can see for the last few years that has been the case. So this goes back 20 odd years. The last big outrun that we had of technology stocks was in the late 90s all the way up to 2000, and then it was negative. And this year has been huge again, a huge uprun. Last year was a negative on tech stocks, but this year has been big as the market sort of tries to look ahead for the peak of those interest rates. And again, yesterday was a case in point where we had a big rally up in the Nasdaq relative to the broader market. So it's been a narrow market. Go to the next slide. The one issue that's been weighing on commentators and investors is obviously the interest rates. This again is a long-term chart. The concern, and these again are some of the thoughts that come from BCA, is that they are still worried that, this, given these high interest rates, and you can see each time the interest rates move up, the trend has been down over these multi-decades, no question, and that's been a huge driver of real asset returns. But it's not a straightforward downward trend. You have these spike ups, and whenever we have these spike ups, and this last one of these last couple of years has been a big spike up, we typically end with some accident. So far, we haven't really seen anything, and maybe as we put out, we'll end with not a sort of a hard landing, but more of a soft landing. But typically, there's a bit of cautionary flags, and the latest big spike up has been huge. At the same time, we saw a big rally in the bonds yesterday. So who knows? Maybe this time we'll come off with more of a soft landing. So those are some of that's the big ongoing story. Are we out of the woods yet? And only time will ultimately tell. If we look at some of the concerns still potentially out there, is that the market has been narrow. So as I said there, it's not generally been broad based. Okay, you invest, across the globe, you've made money. It's been very focused on these large cap, specifically these tech names that have done well. The broader market around the world, Europe, and then especially EM, and we've got just some more points on the EM, have been weak. Obviously, we sit in the EM market. In SA, we know generally the currency, the bonds, and equities have generally been on the weak side. The concern, one of the concerns, and there are always concerns, is that EM has had to hold up interest rates and may not be able to bring them down as quickly as the rest of the world, even as inflation falls. One of the main reasons that they've been having to hold up their interest rates is obviously to protect their currency. The dollar has generally been on the strong side, and that has put some pressure on a lot of economies, especially when they have to import, especially things like oil and that. So these are some of the cracks. Time will tell whether the market will look through this. If we look at China's a big driver, and especially a big driver for EM, and it's been on the weak side, no question about it. As an economy, there are a lot of issues. They haven't stimulated the economy to the same extent as they did post the global financial crisis, where they went crazy in terms of the stimulation. Part of the problem there is that they're having to sort of hold interest rates a little bit higher than what they should. So that's causing a little bit of weakness. And then I think a big factor is in their building, their construction, their property sector, which is still highly leveraged. And so they sit in a tricky situation, wanting to stimulate the economy. This is what we believe, but a little bit stuck in some respects, because the economy is very geared, is over leveraged. And so you can see it. This is a chart just giving a sense of some of the exports. So exports to the rest of the world and exports to US, and there's been a bit of weakness, and obviously China as an exporting country, this is one of the key indicators. Again, and I think importantly, economies may be weak, but you have to look at a distinction often between the economy and the stock market, and so there's always going to be pockets of opportunity in terms of China, and pockets of risk in markets that have done exceptionally well. So we always have to look at that and take that into account. If we go to the next slide, Lisa. This, by extension, gives a little bit of a sense of sort of some of that weakness from China sort of playing out. And that's this commodity. This is the broad commodity index. And then I've put on the chart, this is from Kevin Ling's, the SA mining production. So a lot of emerging markets rely on the stronger commodity market. And the engine of that has typically been China. And so weakness in China extends to weakness in commodity prices. We've seen big pullbacks in commodity prices, especially the platinums and palladiums. And that's been a component which has hurt some of the exports, especially SA, but a lot of emerging markets who export in. So it's the trend has been a little bit negative for the last couple of years after a nice big run up. So yeah, I think those are just a few slides. I think a big factor is this China story that the rest of the world has to watch, and especially emerging markets. If they can pull through and can stimulate the economy and actually, reduce, ease off on or get through the highly indebted situation that they're in, it'll be positive and a risk-on environment. But if there's ongoing weakness, it does put pressure on emerging markets, stocks, credit, and currencies. If we look at the dollar, despite the negative rhetoric, the dollar just has remained strong. We do see signs like yesterday when the inflation number in the US came out slightly below the expectations at 3.2%. Suddenly we have big dollar weakness. Why? Because the market is looking ahead and saying, you know what, these interest rates, we're okay now. The next move is down and we're going to be sharply down. The 3.2% is moving in the right direction, but it's still above the 2% level that at a core level that the Fed really wants to see. So we'll continue to see. Have we seen the peak of the dollar, and will it just go down now? I'm not that sure. I don't think you can just write off the US dollar. There's a lot of factors which continue to prop it up. You've had the US consumer who's actually been very resilient by and large, and we've discussed that a little bit as well. But there are pockets of indebtedness, just in some parts in some of the property market, and again, where there's high interest rates, like they are, if these do persist and they don't come off quickly enough, that is going to have an impact. I mean, we see obviously the extent to which the consumer has a lot of obviously property debt, but especially at these latest levels, when the rate is so much higher, credit card debt. So there's definitely some concerns that the consumer might come under some pressure. And then the last point I think is higher interest rates, and we've said this over and over, are not necessarily negative on a global scale. Excuse me. We've seen both retail take that up massively in terms of putting money into interest rates, and obviously a lot of corporates who are cash flush benefit from these high interest rates, and so both on the short term and to some extent, locking in some of the rates at the higher duration levels, 10-year bonds, and even longer. So these rates, if the trend now is down, this is definitely an opportunity to sort of lock in those rates. It has been an opportunity, and so again, not necessarily a negative. It's a positive for investors. We believe we've seen that in the local market. The high interest rates have been a place where people can park money and a good portion of their savings. And now we've got that on a global scale as well. Time will only tell as to how long that will last. But so positives and negatives. And I think the overarching story is no matter what the headline news says, markets will continue up as we've seen this year. And so there's always something to worry about. but not a bad place to start thinking about global. And especially when we see what happened yesterday with the rand having taken a risk on environment, suddenly pushing that currency up quite nicely from weaker levels. So those are just some of the points, and I'll hand back over to you, Adi, unless there's any questions, and we'll look at some of the detail in our global fund. Thank you, guys.
Thank you, Ian. Guys, any questions for Ian? Ian, maybe just maybe a observation or a hope from my side. I think as the US consumer, which is still the main driver of that US economy, is sort of maxing out on credit and not able to get further credit extension, typically that will point to sort of a recession. You still got the inverted yield curve as well. But we might just be lucky and start seeing interest rates come down as the consumer max out, and that US going to that soft landing. And I guess that will be the utopic outcome for us if that does happen.
Yeah, it will be. I mean, it will be. So far, there's a lot of signs that point to the potential that it's not going to be a hard landing. Only time will tell. Things can change, but so far it's potentially looking that way. It's potentially looking that way. I see things like the M2 money supply rate of change, and it's come down dramatically. So to your point, the US banks, the take up of debt has been much lower, coming off these very high levels. And so the US consumer is a big driver. There's so many interrelated factors. I was just looking at the corporate, and I'm just writing a report on this as well. I mean, corporate profitability for the third quarter, most of the companies have reported now, and the profits are ticking up again. So it's the first time in a year now that on a quarter-on-quarter, for the quarter, the year-on-year has actually moved up, and it moved up 4%. So the profitability is actually ticking up nicely, and the expectation is that it should tick up to 6.5%, and then 10.5% quarter one and quarter two next year. From a corporate, this is across the S&P 500.
Yes.
And the other thing is the margins are high. So your margins are still at exceptionally high levels. So you look at this and you say, ultimately it is about profitability. And I'm just going to put this is just for the bit of a write-up I do on the week. The profit, ultimately, corporate profits trend up, And so if we see a slow recession or a very light recession, we'll be okay, and investors will be okay. Might be it's always going to be a little bit bumpy, no matter what. But maybe we'll get through this thing. And then I think a big factor is, maybe there's potentially a degree of counter-cyclicality to China starting to at some point have to stimulate, and we'll be okay. Time will tell, but as we all know, this is a long-term game.
Thank you.
And that's why I sort of showed the daily or the sort of monthly gyrations. You got to look through the monthly gyrations.
Yes. Thank you, Ian. Jade,
Thanks,
you've
guys.
got a question?
Yeah, I just want to, so on your return graph thingy, Bitcoin is up by 109%. And I know like everyone has different views on Bitcoin, obviously, but now that BlackRock is about to get a license to supply Bitcoin ETFs, obviously that will drive the price up, I'm sure.
Yes.
So
well, maybe the price has been driven up because they are applying. There is a degree of that where it's a normal story of buy the rumor, sell the fact. I mean, there's a degree of that. There's a market is looking for not only BlackRock, but BlackRock is the biggest, and we obviously use a range of the BlackRock funds, the iShares funds as trackers. But there's a number of other financial companies looking to do exactly that, to launch an ETF. Yeah, exactly. You're quite right. The ETFs
do you have a different view on it now, or has your view changed because of this, or it does?
No. I think our view, if they do get endorsed as ETFs, you are quite right. It will be I think a lot of it is in the price already, but will it be continuing be positive? I think so. It has to be, because what you've got is you're bringing a certain asset into the mainstream. We obviously buy, let's say, gold through an ETF. I mean, that's a single commodity into an ETF, and there are, if you look back, there's charts that indicate once that commodity comes into an ETF, so many more people can access it. And so that's the thing. I mean, so many people can't access, let's say, an asset like Bitcoin through the financial markets. But if
it's interesting because there's quite a buzz around it, and it never used to be a buzz because it was so risky. So now the questions are being asked, and now we have to kind of know a bit more.
I don't think the risk will be taken away necessarily.
Yeah, sure.
The risk will still be there. The volatility is still going to be there. I mean, it's a huge amount of volatility there, you can see. But it'll be interesting to, I think it'll be a step in the right direction.
Thanks.
Yeah.
Cool, guys. Let's move on to the global funds. I think, as we said earlier, with the Rand trading where it's at, maybe those clients that's been waiting for an opportunity to go offshore, perhaps a good opportunity. And of course, the Seed Global and Seed Global Equity Funds, potentially some great solutions that you guys can offer your clients. So we just want to give you some real insights as to how they've done, what has worked, what hasn't worked, how it's positioned, and sort of how we see the lay of the land with regards to our positioning. So we're going to start off with T-Man, and then Mike will take over from Tawanda. Thanks, Tawanda.
Thanks, Adriaan, and good morning, everyone. I'll just take you through the performance and attribution of the funds, just to set the scene with the facts of what's happened so far. And then Mike will take you through the positioning, which gives you the expectations or what we expect from the funds going forward. So just to start with, we'll start with the Seed Global Equity Fund. And what we're looking at here is the calendar year returns for the fund. And I think this is a really good way of looking at performance, because it actually breaks the performance down into smaller chunks so that you can see, rather than just looking at one number, that this is what the fund has returned. You can actually see what has been happening on a blow by blow basis, just in the different years there. So if we're just looking at those calendar year returns, I think just a few things that I can highlight there. If you look at 2017 and 2019, pretty exceptional returns in the market, over 25% delivered. So quite a great time for the markets in 2017 and 2019. But then conversely, if you look at 2018 and 2022, quite tough within the markets, negative returns delivered within the market. So you can see that that journey within the markets, it can either be positive or negative. There's a lot that's hidden when you just look at one annualized number. You actually just need to see how the fund behaves in different market environments. So in 2018, if you look at that negative number, the fund was down, but still delivered alpha over the All Country World Index. So the defensive positioning in a difficult market actually helped the fund. But then unfortunately in 2022, it's the opposite that has happened. So in a different market environment, where the interest rates started rising, had inflation pressures, then the positioning of the fund actually lagged behind the index. So a different market environment gave a different result. If you just look at the bottom table there with the quartile rankings and the colors of the quartile rankings, then you can see how the fund has fared relative to the peer group. Obviously, the older history, pretty much first and second quartile, but what you can also see there on a year-to-date and on a 2022 basis, then it is lagged behind third and fourth quartile. So I'll unpack what has happened over the last year in my next slide, just to explain what's been happening with that performance. So if we're just going to look at the performance over the last year, and then just look at the individual components within that Seed Global Equity Fund. Just as a refresher for who doesn't know, it's a multi-managed fund, so it's got different strategies, different funds within it, that obviously are put together, blended together to give a more consistent return over time. So what this graph pretty much represents, we call this the waterfall chart. It just shows the contribution of each one of those strategies over to the total fund performance up to 31 October 2023. So the fund delivered 6.5% over that 1 year period. And what the individual bars now show is what each fund would have contributed. So as an example, the Fundsmith Equity Fund was the biggest contributor to that 6.5% performance by contributing to 2.5%. Lindsay Train was the biggest, second biggest contributor of that return, contributing 1.5%. And I'll just highlight on the other side there, you've got the Scottish Mortgage, which obviously contributed a minus 0.6%. And these are some of the points that I'll be touching on. That third and fourth quartile performance is pretty much a result of that detraction that came from that strategy. So if we move to my next slide, the next slide breaks this 1 year performance a little bit further. So we attribute a little bit further so that we can zone into some of these different components. So there's quite a lot of information on this chart, but I'll try and unpick it for you just to make it a lot easier for you to understand. So at the top there, then I've got the return of the fund relative to the MSCI All Country World Index and the Morningstar peer group. So what you can see there, the fund has returned 7%. Obviously, it's the 6.5% rounded off. I don't have any decimal places in here. The fund has returned 7%. In a period where the MSCI All Country World Index delivered 11%. So the fund actually lagged the MSCI All Country World Index by 4% over that period. The Morningstar peer group of global equity funds delivered 9%. So slightly ahead of the Seed Global Equity Fund over that 1 year period, but also behind the MSCI All Country World Index. So a lot of the global equity funds actually struggled to beat the index over this 1 year period. And then I've got on the bottom part there where I've got the first section that I've labeled top. Those are the top contributors to the performance related to the last chart that I showed you. And I've got something that we've called the alpha contribution here. And what the alpha contribution basically means is that we are saying that the fund has lagged the MSCI All Country World Index by 4%. What is responsible for us lagging this index by 4%? So Fundsmith, over that 1 year period, outperformed the index. So the contribution of Fundsmith is positive. So that's a positive alpha contribution because Fundsmith actually managed to outperform the index over that 1 year period. We've also got some of our structured notes. Mike will be speaking to some of these strategies that we've got. So we do use structured notes wherever we see an opportunity to capture something that is slightly different from or slightly better than what you can get from the market. So 2 of these structured notes were able to deliver a positive or an outperformance over the MSCI All Country World Index, contributing positively to the performance, to the relative performance of the fund. And then at the bottom there, at the bottom of the table, which I call the bottom, those are the detractors on a relative basis. So the strategies or the strategies that have detracted the most from the performance of the fund relative to the MSCI All Country World Index. And I've obviously highlighted the Scottish Mortgage Trust, which is what you would have seen in my previous chart, delivered a negative return. So underperformed the MSCI All Country World Index. And then I've also listed some of the other strategies that did underperform the MSCI All Country World Index. And I think what's also what I would also like to highlight, what's interesting, I think us as multi-managers, we make decisions and we want to make the right decisions all the time. So when we've got a certain allocation that we're confident with, then that's where we would allocate most of our assets there. So you can see the average weight that I've highlighted there for the Lenzo Train Global Equity. That's one of our higher allocations. And wherever we put a higher allocation, then that's where we expect to outperform. But what would have been disappointing over this period is that that's one of our highest allocation, but the fund actually underperformed relative to the MSCI All Country World Index. So detracts from performance, yet would have backed that manager to outperform. So over that 1 year period, over this short term period, then obviously that performance with a higher average weight would be disappointing. And like I said, Scottish Mortgage delivering a negative return would also be quite disappointing, and this pretty much would explain why the fund would have been lagging the MSCI All Country Index over that 1 year period, and that speaks to that relative performance that we had on the calendar year returns lagging behind in the recent past. These are the strategies that would have contributed to that. If we move to the next slide, I'll just zoom into the Lenzo Train Global Equity and the Scottish Mortgage Global Equity. Just as a refresher, Lenzo Train was the highest allocation but underperformed the index. Scottish Mortgage delivered a negative return, underperforming the index as well. So if we start with the chart on the left, which is basically a depiction of that underperformance, of that 1 year performance again, but we're just looking at on a risk and return basis. So you can see that negative return from the Scottish Mortgage in that blue square just at the bottom there. It's been quite a volatile period, so a lot more volatility, and it's underperformed as well. The blue, the darker blue circle, that's your Lenzo Train Global Equity. So a lot closer to your peer group average, a lot less volatility than your index, but still an underperformance. So that short-term period has been a difficult period for these strategies. But if you look on a longer-term basis, which is what we try and look at to build expectations or what we expect from these funds, a strategy like Lenzo Train, you can see that on a longer term basis, and this is since a common inception, April 2011, you can see a bigger outperformance relative to the peer group and the index at low volatility for the Lenzo Train. And then Scottish Mortgage, being a growth strategy, also does tend to give more outsized outperformance, but tends to also be a lot more volatile. So you see a lot more volatility, but what it adds to there is when the growth strategies have an upward swing, then that tends to capture a lot more of that upside. If just focusing on that 1 year return again, what has obviously changed, the themes that we've been talking about within the markets as the inflation has been rising and as the central banks have been raising interest rates to try and calm that inflation that has been facing the markets, then the growth strategies, which are generally called long duration strategies, have underperformed in that period. And as you would know, the value kind of strategies have done a lot better within this period. So the higher interest rate environment has favored valuation triple strategies, and the growth strategies have lagged behind in this environment. If we move on to the next chart, just to put a bit more perspective into how these styles perform in different interest rates environment. Here I've just got a growth chart on the first chart. It's on a 2 year basis, just to show that as interest rates over the last 2 years have been rising, then as represented by the MSCI All Country World Index, that value index has outperformed the broad MSCI All Country World Index, and then also outperformed the MSCI All Country World Index growth index. So on the short term, where we've seen these interest rates rising, then we've had the value outperformance. But then if we look on the right hand side, where we've got a longer term chart, that obviously covers a period where we've had lower interest rates environment, then those growth strategies have tended to outperform in a lower interest rate environment. So the big question is inflation under control globally? are the interest rate increases coming to a halt? Have they peaked? If that environment, if we are going to get a peak in the interest rates, and obviously maybe the central banks start reducing interest rates in the near future or whenever, then that will be a tailwind for the growth oriented strategies that tend to do well in that kind of an interest rate, a lower interest rate environment. And that would be positive for the likes of a Scottish mortgage, which has obviously struggled in the recent past, and your Lindsay Train and Fundsmith, which are quality but have a growth orientation to them. They would also benefit from that environment. If I move on to the Seed Global Fund, again, just for the Seed Global Fund, we'll look at the calendar year returns and then also at the quartile rankings at the bottom. If it's obviously a similar picture, just in terms of what we looked at, with the global equity obviously being a component of this Seed Global, then you see the similar themes that sort of come into these calendar year returns. But if you look at the bottom quartile rankings, then pretty much it's been first quartile and second quartile, and for reasons that we've discussed on the Seed Global Equity Fund, then we see on a year-to-date and for 2022 that the fund has been third quartile, so lagging behind some of the peers just on that basis. And if we move on to the next chart, just to break down on that waterfall chart again, if we just look at the 1 year performance for the Seed Global Fund and what has contributed or detracted from that performance. So Seed Global Funds, being a flexible allocation fund, has exposure to different asset classes and different managers. So what we've put in here is the asset classes and how they've contributed. And as you can see, with equity being the biggest building block in that's contributed the most to the strategy. But we've also got the alternatives where we've got our structured notes contributing. Gold was also a big contributor over the 1 year. And what you can see on the detractors, then we've got the bond being a detractor, as we've got an allocation to the US treasuries, which I'll unpack in the next slide or two. But that's obviously been a detractor as this interest rate environment, as interest rates have been rising. Then we've also seen the yields on those US treasuries going up, which has obviously led to short-term capital losses. That's why we see that negative number on the bonds. So if we just move on to my next slide, so just to break down that asset class 1 year performance just in a little bit more detail, just going through the different asset classes relative to some respective benchmarks, then we can see there. I won't spend much time on the equity because that has pretty much been covered on the Seed Global Equity Fund, but obviously lagged behind the MSCI All Country World Index over that 1 year period, and also slightly lagged the Morningstar peer group. The top section just shows you the Seed Global Fund, which has returned 3.5% up to the 31 October. And relative to its peer group, that's 0.1% ahead of the peer group average. I mean, the 3.5% looks like a low return in compared to what you've seen in the history, but obviously it's been a tougher period, as you can see by the peer group average as well, for the funds within that category. Being a little bit more defensively positioned, I've got cash there, which is at an average weight of 17% over this 1 year period. That's a more defensive positioning. So as you started to get a yield within that cash environment, a global fixed income environment, then we've allocated a little bit more to cash. And this has come with fears of a recession within the market. As interest rates have been rising, then that is expected to put pressure on your global economy, and to protect the fund, then we've obviously increased that cash allocation, and that's obviously delivered a 5%, so decent performance. And this comes out of a prior period where you had global yields basically sitting at zero. The alternative, that's where our structured notes come in, and that's delivered healthy return of 11%. I've compared it there to cash, bonds, and the MSCI country owned index, your equities. So the basket of structured notes that we've had has been able to actually outperform cash, bonds, and equities over that period. And on my last slide, just to go through the rest of the asset classes, or the other strategies that we've got, I think Ian did speak to some of the difficulties that China has seen, and that China over this period has obviously, we've got the Pressing China Balanced Fund that's obviously had a bit of a difficult time within the market. So a return of 1%, which is slightly behind what would expect on a longer term basis. I've compared it to the CSI 300, which is a pure equity benchmark. The fund actually is a balanced fund, but it does track that CSI 300 equity and does aim to outperform that equity index over the long term with much lower volatility. Bonds, I've spoken to you. We've got an allocation to the US Treasuries there, and the longer dated US Treasuries, as the yields have gone up, have obviously delivered a negative return. Gold has actually been a good asset class over this period with that 20% return. So that's been a contributor to the overall fund performance. And then we've also got a smaller allocation to property. Property being another risk asset has also lagged behind in the current market. And our property manager is one that allocates a lot more to quality type of properties. So in a rising interest rate environment, that has also lagged behind. But these strategies that we expect over the long term to benefit or to have a tailwind from peaking of interest rates and potentially interest rates coming down. So this is a depiction of the performance and what's obviously happened over the last year and over a longer term period. I'll then just move on. We'll move on to Mike, who will take you through how the fund is positioned to give you a better picture of what we might expect going forward.
Thanks, Tawanda. Yeah, good to see you guys, and yeah, nice to hopefully finish up and get the year off to a great ending. And as I guess Ian said, so far November's been a great month for most assets. So hopefully when you send out your client statements in the middle of December, they can end off with it on a good note. So yeah, I'm going to be looking at the global funds, global equity and global. Tawanda's obviously gone through the attribution and kind of things that have done well and not so well. I just want to remind you guys, I mean, we've got our global funds are differentiated from, I guess, your stock standard vanilla funds. Both funds we investing across the different investment managers, different investment styles, different geographies, and then different types of investment vehicles. So we're not a vanilla fund of funds. We are able to invest into closed-end vehicles like Scottish Mortgage. We are able to invest into structured notes. We can invest into ETFs. So we've got full flexibility into the type of investments we can invest into. But obviously, as multi-managers, we are looking to blend and diversify across a range of strategies. In the global fund, obviously, there we're doing asset allocation as well. So for clients who maybe have a slightly more moderate risk profile, your C Global is great from a core building block for global allocation. And for your younger or more aggressive clients, the C Global Equity, great fund. We obviously managing it actively. We're putting in managers that we believe will deliver great long-term returns. As and when those views change, we are happy to change our portfolio. If we find better opportunities, we'll include those into the fund. So as advisors, I guess we hope to make your job a little bit easier, that you don't have to worry about selecting managers and then keeping on top of whether they still are relevant or not. If we look at a bit closer now at the Seek Global Equity Fund, so as I mentioned, there's broad diversification across the different geographies. Obviously, United States is a big region. From a listed market, it takes up 62% of the MSCI ACWI, which is All Country World Index. We are slightly overweight, given where we are in the cycle. The US typically has less risk on the downside, more resilient types of companies than I guess where other sits. Other within this context is largely your emerging markets. So while our benchmark does have an emerging market component to it, in our global equity fund, we don't have any specific direct emerging market exposure at the moment. On the sector side, I guess as Tawanda mentioned, the kind of sectors that we're exposed to are your higher quality sectors, so consumer staples, information technology. I mean, that's technology kind of companies are very core components of most other industries these days. Healthcare is always important, whether the economy is good or not. Your healthcare stocks should do well because people value their health. And then our underweights on, I guess, are your more cyclical type sectors, something like financials, industrials, energies, materials, those sectors where they are more reliant on the economy doing very well. And again, with the economy running very hot, interest rates staying high, we have seen those sectors doing well, and that kind of, to a certain extent, from a sectoral basis, will explain some of the underperformance over the past 12 months. But given where we are in the cycle, we think that this is a very prudent and positioning. If we break down the global equity fund into the various kind of building blocks, so we have the same on the global fund, where we have our core exposure. So these are typically larger allocations to active managers, typically those strategies that we're looking to hold for longer term. So again, we want to hold it for longer term, but we are happy to remove them if the situation at the underlying manager changes or if better opportunities arise. We then have a range of satellite exposure. So sorry, on the core side, I mean, that's sitting around 40-odd%. Just around a quarter of the portfolio is into satellite. So that is into your ETFs, your trackers, helps us to keep our costing of the fund quite low, and gives us exposure to certain drivers. So given the research from BCA and the positioning of our other managers being typically underweight US and wanting to have a slightly overweight allocation to the US, we have got an S&P tracker. The cost of that tracker fund is 0.07%. So it's basically managed for free, a very efficient market. So for us to gain exposure to the US market, going via the S&P trackers is the most efficient, and probably one of the better return opportunities for us. So we'll build that satellite. At the moment, also a large exposure to the Minvol component, given where we are in the cycle. We would expect that as if we go into recession and the market then comes out, interest rates come down, and as we get more confidence in the global equity market, we'd probably shift more into a momentum type strategy. But again, that's something that we can do and manage actively and dynamically for you as the advisors. And then finally, on the bespoke component, has been a sort of quite a decent chunk of the portfolio. This is to a range of structured notes. We've got them there. We would expect them to deliver equity-like returns, and they all have some element of capital protection in them, not necessarily full capital protection, but a certain component of your capital is protected. So they do offer this asymmetric payoff profile. I've got a couple of slides later on about the structured notes and how they've done for us. The booster notes typically giving us geared upside to up markets, and none of them really are looking to cap your performance. So while bond yields have gone up, given how these notes price, they price off the bond market on sort of the fixed income component of them, they have come under a bit of pressure from that side. But when we look at the return expectations between now and when they mature, those expected returns just increase over time. And the beauty of these structured notes is that when you invest up front, you've got an explicit payoff profile and an explicit maturity date. And so it is quite easy for us to understand, okay, if the markets deliver X type return, this is the kind of return that they will deliver. And if the markets come off, protecting capital and the markets head up, we will generate some great returns out of that component. Onto the global fund, just a sort of overall positioning. So I guess given from what Ian's spoken about, Tawanda's spoken about, we are fairly conservatively positioned here, 10% underweight to equities. And again, a lot of that it's also slightly underweight in property, and the bulk of that underweight exposure is shifted into the alternative. So within the global fund, our structured notes are slightly more conservative than the global equity, given the more conservative risk profile of the fund. So there will be more capital protection and potentially some sort of upside capped, but again, still generating returns that should be well in excess of the fund's benchmark and peers, and also helps to reduce the portfolio's volatility. And I guess speaking to this, I mean, as Ian said, there are questions about the future. We know the world is never going to be, or the future is never going to be forecastable with accuracy. So the great thing with the global fund is that it's broadly diversified across asset classes. If we hit some turmoil, we've got exposure, like economic turmoil, we're going to like a recession. We've got the bonds, which should do well. We've got the cash that will hold up nicely. We've got capital protection alternatives, and even one of the alternative strategies, we should profit in a sort of recessionary type environment. Gold typically also can do quite nice in a recession as people seek a safe haven. So we've got just under half the portfolio that should do well or should do relatively well in a risk-off environment. But again, the markets run a lot longer than we would have expected. And with that, we do have the sort of half of the portfolio still in equities, which should still do well if the economy carries on to remain strong. Just again on the positioning. So what you will see is that a lot of the names within the global and the global equity fund are similar. I mean, it's obviously one view, it's our best view. Within the global fund, we obviously have a bit more risk cognizance there. We have Prescient China, Prescient China balance, which comes into the core component. Tawanda's mentioned has had a bit of struggles. And Ian's obviously mentioned that the economy is maybe not as strong as it's been in the past. But I've got a slides on that and why we keep on including the portfolio. Again, we've got the core active managers should deliver, and they all have delivered excellent risk-adjusted returns versus their benchmarks over the longer term. On the satellite side, there we are looking at the trackers. So gold, getting bond exposure through trackers is the easiest and most efficient way of doing that. We've got a fairly long duration on that bonds, which should be the part of the bond market that will do very well if there's a big risk off environment coming up. And then on the bespoke side, again, largely the notes. Within the global fund, we put the Scottish mortgage into more of the bespoke side, given us a smaller sort of not necessary core holding within the portfolio. We just classify it slightly different to where we do in the global equity fund. As I mentioned earlier, so that bottom note, the GS convexity notes, that's a note which is actually designed and it's actually one of the components of the fund that I hope does badly. Because if it does badly, it means that the rest of the portfolio is probably doing very well. But it is a bit of an insurance policy for the portfolio. And again, should there be a big risk off and maybe a deeper recession than people were expecting, that component of the portfolio should hold up. And how we've designed the rest of the portfolio, we should do very well on a risk-adjusted basis. Finally, on this side, so we've got a big chunk into cash, so the BlackRock liquidity, as Tawanda mentioned, yielding now in excess of 5%. Nice. We have sort of 1 day liquidity, so if we want to upweight any of the other asset classes, quick and liquid, but it's giving us a nice, decent yield. So it's not kind of burning a hole in our pocket that cash used to do for much of the past decade. So just to kind of speak about the differentiated positioning, so we know...
Mike,
Yeah.
I'm sorry to interrupt. I
Sure.
think we're running a little bit short on time.
Cool.
So maybe we can pick these differentiators up next time. Maybe if we don't mind just touching on the costs quickly of the two funds relative
we
to peers.
we can go through. Yeah. So
And
maybe
then-
just pop through, Lisa, this chart in the next. We'll just do this one on China. So this one, I guess, a key here is that while China necessarily is typically a more volatile market than the rest of the other markets, when you place on an upside downside capture, so the chart on the right, you can see that present China has managed to deliver 60% of the markets, global equity markets upside, but only 40% of the downside. And this is because China is very uncorrelated to the rest of the world. And so it does form a great building block within a portfolio, an uncorrelated component. And then maybe just briefly on the structured notes, on the next slide. So we can see, so this is the structured notes within the Seed Global Fund since the middle of 2017 when we first included them. They've done better than the equity market with kind of bond-like volatility, 90% of the time, just under 90% of the time, delivering positive 12-month returns. So they have been a very core and key component of our portfolio, slight differentiator from what other people do, and something that we will continue to look to include in our portfolios. And then finally, just on the costing side, so I guess most of you guys will be accessing these funds via the feeder funds, which obviously, again, those are the Rand denominated funds where 100% or close to 100% of the money is invested into the underlying global or global equity fund. When we're looking at the TER of our funds versus the range of peers, you can see, so on the global side, we actually sit slightly below average. We've just listed some of the other short list and peer type funds, or more well-known funds, just for reference to see where they sit versus the Seed Global Feeder Fund at 1.55%. And then I think more importantly, in terms of the costing side in the Global Equity Feeder Fund, there we've been, I guess, very aggressive with our fees. We've intentionally designed this fund to be sort of on the low end of the fee structure. You can see the well-known names. We've got Global Franchise, we've got Fundsmith Equity, are a fair bit higher. And the beauty is that you can get Seed Global Equity. We've got exposure to Fundsmith. We've got exposure to other strategies that are also relatively expensive. You get the multi-manager layer of extra due diligence and management on top, and still comes out very attractively on a cost basis.
Thank you, Mike. Yeah, that makes for a compelling reason to look at these funds for your clients' offshore investment solutions. Guys, any questions? I know we've run a little bit over time. We apologize for that. We had a lot we wanted to share with you, and I'm sure if we leave Mike alone, he can talk for another half an hour quite easily. Any other questions, guys? We want to wish you all the best for the last run of the year, and we look forward to seeing you guys for our first session again next year. Be safe and good luck.
Thanks
Reach
very
out
much,
if we can
everybody.
help with anything.